Hard times don't last, hard people do, boys. What's up, sons? Welcome to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Blind Run in the interwebs. That goes back to my gamer tag all the way to, of course, Counter-Strike. Not Go. This is before Go was even a thing. It was the release of Steam. Other than that, in real life, I go by Matthew. Today's topics, we have Flux and Terra are now building a decentralized future together. We have the Other Deed launch for Other Side, causing, of course, some hubbub in the fee market, as well as just the general Ethereum layer 1 issues. We also have like a ton of burns that happened as well. And a new announcement from, of course, Yuga Labs that they are going to begin working on their own chain, which I think is huge news. Ethereum devs also have decided not to delay ETH's difficulty bomb on Friday. We talked a little bit about that in last night's video. We have some more info. We'll dive a little bit deeper. And then we have Solana being down for 7 hours due to basically a bot crowding problem we'll get into. And then we're going to talk a little bit about the markets because the markets are down. Obviously, everything within mining is down. Things are stressful. We're going to talk about it. I'll give you guys some of my thoughts and opinions on it. And of course, we'll talk about crypto mining profits. Before we get into it, to make the money and help the channel survive, we have an ad from Crypto.com. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. Alrighty, so let's get into it. We have a big show today. Obviously, I did not sleep very well, so hopefully I can articulate well enough. And if there's new information, of course, we'll gather it in the chat with your questions at the end of the show. Let's start off with some more bullish news to get, a little bit up today. We have Flux and Terra are now, let me fix this real quick. I knew I'd forget something. There we go. Flux and Terra are now building a decentralized future together. This is on the Flux official Medium page, and it says, "Welcome to a landmark day for Web3. Today, we are happy to announce that Flux and Terra are joining forces. Working together, Flux and Terra will integrate their ecosystem and bring you the very best Web3 has to offer. Terra is one of the hottest and fastest growing ecosystems in blockchain. It's a public blockchain protocol deploying a suite of algorithmic decentralized stablecoins, which underpin a thriving ecosystem that brings DeFi to the masses. Terra is a regular treasure trove for blockchain and DeFi enthusiasts with 100 plus projects across DeFi, Web3, and NFTs in the ecosystem. From censorship-resistant stablecoins to high-yield savings in synthetic stocks, Terra is building a powerhouse of financial services powered by blockchain technology and available to everyone. It's decentralized finance at its finest. Flux is the leader in Web3 decentralized infrastructure. It is a comprehensive suite of decentralized computing services and blockchain as a service solutions. The Flux ecosystem provides Web3 developers with tools, services, and infrastructure needed to deploy their applications in a fully decentralized manner. Flux has a powerful decentralized computational network consisting of more than 11,000 Flux nodes with a combined 78,000 CPU cores, 238 terabytes of RAM, and 5,000 terabytes of storage. When you take some of the best applications in Web3 and put them on the best decentralized infrastructure available, you get blockchain magic. This collaboration will focus on the deep integration of ecosystems and will leverage the respective strengths of Flux and Terra to jointly build the best tech, the best applications in blockchain. When 1 + 1 equals Web3, simply Flux plus Terra will equal Web3 is what they're saying here. If you're wondering, Web3 is the internet of the future that leverages emerging technology such as blockchain to deliver a decentralized internet focused on the empowerment of the users, the people of the internet. It enables people to take stewardship of the internet rather than being forced to place their trust in centralized actors such as corporations and banks. The purpose of Flux is to provide the required tools and infrastructure to enable developers to build and deploy their decentralized applications on Web3. The goal of Flux is clear: to build the internet of the future, a decentralized Web3. Terra states in their white paper, quote, Terra is looking to become the first usable currency and stable platform on the blockchain, unlocking the power of decentralization for mainstream users, merchants, and developers. In other words, Terra aims to bring censorship-resistant money to the masses and empower individuals through an open, accessible financial ecosystem chock full of powerful applications. Working together is mutually beneficial for Flux and Terra. Flux gets closer to the goal of building Web3 by adding killer Terra applications onto Flux's decentralized infrastructure. And Terra gets closer to its goal of unlocking the power of decentralization as their ecosystem transitions from Web 2 to Web 3 infrastructure. The end result, more Web 3 empowerment for those operating within the Flux and Terra ecosystems. Here's what it will initially include: development of Terra on the Flux ecosystem to push for deeper decentralization. Flux will deploy decentralized apps from Terra ecosystem on Flux, Mir, Anchor, and more. For more information on the network, you can visit the Flux OS dashboard, which has information on network resources, node rewards, application deployments, and DAO governance. Launch of Flux token on the Terra blockchain. The Flux ecosystem utilizes parallel assets or tokens on other blockchains to enable the Fusion cross-chain bridge. This provides the Flux ecosystem with better access to DeFi as well as other development opportunities. A snapshot will be taken on May 5th, and eligible Flux holders will receive the initial distribution of Flux tokens on Terra at a later date. So if you guys aren't aware, just to kind of clarify that a little bit, I believe this is in relation to parallel assets. If we go to, let's see, minerpool.org, we can show you guys here real quick exactly what that looks like here. All right, so if you're mining Flux, you get paid out in essentially not only Flux, but a portion of Flux in parallel assets. These parallel assets currently include Cadena, Ethereum, Binance Smart Chain, Tron, and Solana. Now, you are still, of course, earning your other parallel assets here. You can see that on my wallet, I still have, 5 more. My understanding is that essentially you should see here at some point, whenever they announce the date, that you will get these Flux tokens on the Terra network. Now, it's important to also note about this, because I was messing with this when we did our how to use MetaMask tutorial. There are some issues with low liquidity, not some, a ton of issues with low liquidity across both Binance Smart Chain as well as Ethereum for Flux tokens. In fact, it's to the point to where I think that you would be more advised, in my humble opinion, if you want to support the network, to actually add liquidity in these parallel chains as opposed to actually building nodes. One, you're going to have a little bit less infrastructure to deal with at that point because you're just adding on to those networks. Two, you're going to be basically allowing people to go ahead and realize that Flux does have these parallel assets on things like Ethereum and so on. And I think that it's needed. Right now, you really don't have enough. I've added some on both Binance and as well as on Ethereum, but mine's not enough to really make up for the lack of liquidity within these parallel assets. And I think that that is going to be an issue moving forward. So just something I wanted to talk about a little bit there. The official Flux wallet and blockchain application suite, Zelcore, will support Luna as well as many other Terra native tokens such as UST, KRW, SDT, and much more, as well as integrated support for many CW20 tokens like MAAPL and MTSLA, and so on. Users will also have the ability to import any Terra token they want. If some token is present on the Zelcore backend exchange engine, it will also be available to be swapped. Zelcore also provides direct access to centralized exchanges like Binance, Kraken, FTX, and more. But why stop there? Flux and Terra are building a collaborative space that will run deep and bring many more exciting developments down the road. The entire Flux team is looking forward to working with Terra. I have a lot of respect for the Terra team. They set a clear goal and vision for themselves, and they're delivering on that vision with great dedication. I love their approach to DeFi and all the great opportunities their ecosystem provides for everyone in the blockchain space. I'm excited to think about the great potential of working with them and integrating our respective ecosystems. And I'm most happy that Flux can help them decentralize by deploying their applications on our powerful network of Flux nodes. Flux has found a new friend and ally in the quest to bring Web3 to the masses. I think it's fair to say that the future for Web3 looks brighter as every day goes by, end quote. And that's from Daniel Keller. You can go watch my interview with Daniel Keller on this channel as well. Web3 is growing every day, and so is the demand for infrastructure. The Flux ecosystem is the leader in Web3 infrastructure and is committed to being the best decentralized tech stack available now and in the future. To be the best version of itself that Flux can be, we need some great friends to help us grow and develop. We're honored to be working with Terra and have them join our Web3 family of awesome teams hard at work to deliver a new decentralized internet. Flux is fueled by community, so we invite you to come take a part. All are welcome. It doesn't matter if you're just interested in the technology, an investor, a developer, or just like to make crypto memes all day. Flux needs all kinds of people to participate in the decentralized future. And on a note to that too, of course, if we're looking at the most bullish coin to save proof of work mining, it does feel like Flux because they are so heavily integrated into Web3 at this point, especially with the infrastructure. So I wanted to point that out. Come check out official Flux website, blah, blah, blah. If you want to witness what Flux has built so far, you can, visit the Flux network dashboard and see how many nodes they've got online, that sort of thing, the resources available, what dApps are already running, and what the current rewards are for Flux node operators. And also, please stop by the Flux Discord. I do wish that they would reach a little bit more into the miners and address, of course, specifically what this means for parallel assets and miners. I do think that, unfortunately, this entire post did seem to completely bypass miners. I understand that what they're working on right now is getting people to buy nodes because realistically, for Web3 to be successful, they need a lot of processing power, and the nodes are what provide the processing power, at least until they get further down the road with useful proof of work, which some people, don't think is possible. I think it's possible, but I think it's going to take a lot of work, and I think has been put on the back burner for quite some time. So hopefully we will see that, because that GPU processing power could definitely change the game for them. The only other big thing that could really change the game for them is, of course, persistent storage, which we've talked in detail about to great lengths in the past. Maybe if you guys would like another update on Flux as a whole, let me know. We'll do a dedicated video. So what happened this weekend, we talked about it yesterday in a video. I made a dedicated video to go ahead and get it covered for you guys. But we had on Saturday the launch of the Other Deed NFTs on the Ethereum blockchain. That comes from Yuga Labs. If you're not familiar with Yuga Labs, they are basically the brainchild behind Bored Ape Yacht Club, which is also a part of ApeCoin, which is a token, an ERC20 token. So I really hate that they used coin as the term. Go watch my video on there are so many coins to understand the differences between all of them, because I usually try to basically make sure that I define the difference between a coin and a token as a coin that's running on its own chain, and a token as something that's running on another chain. So in my opinion, ApeCoin is a token, but maybe they named it ApeCoin because they, at the very start, planned on it being its own chain, and we'll get into why. So here is the other deed OpenSea page. As you can see, the floor price is 4.5 ETH. Floor price means the average of the lowest price of a NFT within the ecosystem that has sold. So you're talking about, 4.5 ETH here, easily like getting close to that, 10K for just a single NFT at the very lowest, right? At the least valuable one. And it was one of the, I think at this point, probably the largest launch for NFTs that we've seen, specifically as it relates to the amount of demand it put on the network and the amount of fees that drove it up. Now, to give you guys a little bit of an idea, because there's always a little bit of confusion around here, miners earn rewards in two separate ways. And this is pretty much true from the inception of mining with Bitcoin. And that is essentially they solve a block. Well, what's in a block? Think of it as a ledger or a submission of a whole bunch of transactions that want to get solved on the blockchain. Imagine basically what the miners are doing is confirming whatever the users have sent to them and saying that they want to perform. Not really much different than like a credit card transaction getting settled, at a credit card company, whether that be Visa or MasterCard or whatever else. So that's pretty much the goal of the miners. In return for that, miners earn two things, at least at this point across the board. There's none that have migrated into the final phase, which we'll talk about as well, but they get a block reward that is part of something that is known as like a minting process. So as opposed to, the US government that just goes out and says, we need some more money to pay for some more wars and support wars across the globe. And okay. As opposed to that, and then they print more money. What you have is essentially a minting process that is verified by a proof of work. And the proof of work is essentially able to do this because it has some sort of energy cost behind it. And that energy cost is what gives value to the entire cryptocurrency ecosystem. I don't really care if you want to argue about proof of stake, sure, okay. But the big daddy, the one that basically governs all the rest of blockchains, Bitcoin, derives its value from proof of work, which is derived from the actual energy cost to produce these new blocks. So energy is specifically the reason why you have a mint that is valuable. So those new coins that come in, their value is essentially thanks to proof of work on Bitcoin and other blockchains, translated into, of course, the value of that coin when it's minted. The other thing that miners get when they go ahead and go through this process is a fee. And so these fees are stacked up on the blockchain. Essentially, whenever somebody submits a transaction, they agree to pay a fee to the miner, and the miner also gets a fee. So essentially you have your block reward plus the fee. Now, Ethereum changed, of course, their monetary policy with a proposal called EIP 1559, where now they burn a portion of these fees. That being said, you still get a portion of the fees to a certain extent, depending on where that block is in the chain and how the base fee functions and so on. For more details, check out my video on EIP 1559. We've discussed it at length in detail plenty of other times. That aside, what happens is also on Ethereum is that you have not only bots, but people that are manipulating, I suppose, the order of the transactions to essentially get some sort of advantage over the next person in line. In fact, within the same block, you have some smart contracts and so on that will get deployed to the network, where someone will inject essentially a trade at the top of the block, and then immediately after that go ahead and inject a trade back. And they do this to generate, obviously profits. This is part of the problem with a lot of it. So your order of transaction, though, is determined by the amount of fees you want to pay. So if you ever go into MetaMask and you're going through a transaction, it can say like speed up this transaction. That's a very simple way for you to go, hey, I'm going to pay more in fees, put me higher in the ledger, the block, to go ahead and get solved quicker. And when people are purchasing, obviously, high value items on the blockchain, such as, of course, Otherdeed here, what ends up happening is that everybody's trying to get their transactions in as fast as possible, and it drives the fees way up. So on Saturday, this happened for a few hours. We discussed it yesterday from the miner's perspective, so definitely go watch that video. And that also causes, of course, network congestion as well, especially because we have a lot of other stuff going on with difficulty and so on. So at the end of the day, you saw as a miner essentially a whole bunch of additional rewards for a couple hours. Now that messed up the API for almost 24 hours. And the API is basically just a list of calls in software for basically a web application, something like what to mine, to pull the current data over. Well, what happens is if you average that out over time, it's going to make it look like your rewards are much higher than they actually are, because the rewards that were higher were significantly higher, but only really actually for a couple hours, as opposed to 24 hours or a longer period of time, right? So you need to be a little bit careful when you're looking at these different tools, mining calculators, and so on, because these changes aren't going to reflect a quick 2-hour change that threw everything off. So be very careful. Now, this did cause issues with, of course, the NFT launch, and Yuga Labs discussed this, and they said they wanted to say a few words in the thread. So basically, they say, we know the other land mint was unprecedented in its size and high demand NFT collection, and that would bring unique challenges. Now, they talk about basically trying to do KYC to prevent it, some of their strategies to basically make it not have an issue, but they say, essentially at the end of the day, we are sorry for turning off the lights on Ethereum for a while. It seems abundantly clear that ApeCoin will need to migrate to its own chain in order to properly scale. We'd like to encourage the DAO to start thinking in this direction. Now, we could get into tinfoil hat conspiracy theory here too. If you want the best advertisement to build a centralized chain to control all of your NFTs, maybe you do basically have a section like this and don't fully vet it, because there are scaling options they could have used outside of Ethereum to basically prevent this. There's a ton of different options out there. Or they could have just developed ApeCoin right off the bat as a side chain, a layer 2 option. And that wasn't really what they did. It seems like they want to push the ecosystem, in my humble opinion, into their own ecosystem with their own chain and separate. Now, will that allow you to take your ApeCoin off of ERC20 into the separate chain? Preferably, hopefully that probably is what happens. this is probably bullish news in my own humble opinion for ApeCoin from a price standpoint. From a fundamental standpoint, not so much, but I think that it is going to, obviously because of Yuga Labs' influence over the entire market, especially with NFTs, I would say that even though ApeCoin's down right now, with this kind of little announcement that it turns into its own chain, it's going to be a big deal. Okay, so let's talk about that though. Let's talk about side chain options. Let's talk about, before we get into the Ethereum stuff, Solana. So, and then we're going to tie this all together, okay? So Solana experiences a 7-hour outage due to bots crowding the Candy Machine NFT minting tool. So keep in mind, what you have here is basically on the same day, we had kind of two semi-large, one really large NFT launch, right? Like Yuga Labs is way ahead of whatever this NFT mint is. That being said, Solana is still the only other one that's really minting NFTs at a higher level. Meaning like most of the other options out there, something like Cardano, Polkadot, we could go to the proof of work ones, Ravencoin, Ergo, I would probably put in with kind of Cardano, even though the NFT marketplace is separate. Nobody's really anywhere close to Solana and Ethereum at this point. So it's important to note that what we see in comparison really here is proof of stake versus proof of work in operation. And while Ethereum, they say lights out, it didn't fully go down or anything like that. It was just unusable due to fees. In this case, though, for almost 7 hours, the Solana network was not processing blocks. This means that blocks completely stopped. That's not what happened on Ethereum with the largest mint ever, as it sat on proof of work. But bots had swarmed the popular NFT minting tool known as the Candy Machine, halting the network. The outage started on Saturday around 4:32 p.m. till around 11 p.m. Eastern. To prevent similar outage, the developers at Solana will soon deploy a botting penalty to stabilize the network. Late Saturday, the Solana network suffered an outage that lasted almost 7 hours, during which the network was not processing any blocks. Block production came to a halt between 4:32 p.m. till around 11 p.m. Eastern. We read that already in their points, but okay. The root cause of the Solana network not being able to process transactions during this time was bots that had bombarded the popular NFT minting tool known as Candy Machine. According to the Solana status Twitter page, the Solana mainnet lost consensus after an enormous amount of inbound transactions flooded the network, surpassing 100 gigabytes per second. This is hard. So they didn't do if it's a capital G and a lower case B, it's gigabits per second, probably what it is. If it's a capital G and a capital B, then it's gigabytes per second. Anyways, engineers are still investigating why the network was unable to recover, and validator operators prepare for a restart. Furthermore, a botting penalty program will be deployed as part of efforts to stabilize the Solana network. So I do want to point something out here, because there's always been arguments over block size in Bitcoin. And part of the thing has to do with the arguments of transaction speeds and amount of transactions. Now, I would highly recommend that you go listen to Michael Saylor's podcast with Lex Friedman for more information on this. But the real idea that you need to understand here is that layer ones for blockchain don't need to have large blocks. They don't need to be able to necessarily even process millions of transactions at a time. What they need to do is be reliable, right? They need to be reliable and future proof. So being slow is fine. This is what we refer to as layer one. When you get to the point of wanting to actually have a ton of small transactions, let's say, that perform very quickly, what you should develop on top of the blockchain would be something that provides some sort of settlement under a layer 2 solution. We could get into layer 3 in a different video. Maybe we could do a whole entire breakdown of layer 1, 2, and 3 and how they all function together. Suffice to say, what you want happening with your layer 1 is solid, future-proof, unbreakable technology. And that, to a lot of people, means basically smaller block sizes and just reliability, right? So that's where really you have the technology already to build the layer 2s on top of these. What Solana tries to do, obviously, is kind of be the best of all worlds. But what that ends up resulting in is vulnerabilities like such. Concerning the market impact of the outage, Solana was comfortably trading at around $91 before it happened. However, as soon as news broke that Solana was not processing transactions, Solana dropped by almost $10 in less than 4 hours to a local low of $81.91. This is a 10% drop in the stated period. At the time of writing, Solana is trading at $89.25, below the 3 crucial moving averages of the daily count. Of course, a lot of these sites are going to be concerned about price, but the real concern you should have here is the technology. So what is Solana? You're going to be having basically a proof of stake network that has larger block sizes, that sort of thing. And it is causing clearly some problems for stability on the network. Now, we could try to say, you could try to argue that, well, it's a botting problem. But if you design the network in a way that properly, that's, future-proof, that's going to be able to handle this type of thing, then this wouldn't be an issue in the first place. What do we do moving forward? How does that compare to Ethereum? Of course, like we said, Ethereum didn't go down. The problem with Ethereum is the fees. And obviously, like, part of the fix they were going to do with the fees was EIP 1559, which really put a huge burden on the miners, when I think you could have probably done something different. Like I've always said, I think MEV needs to go away, for example, would be one thing, but I don't know how you really necessarily, I'm not a developer. These are just my ideas in general. But to me, what we saw on Saturday was basically an example of what ETH may end up turning into once it moves to proof of stake, when we get examples like Solana. And it could be dangerous. This is basically proof of work versus proof of stake in practice. What are the advantages, right, of proof of work? Well, it's going to continue to process the transactions, right? What are the disadvantages? Obviously, as we see it, if we just compare these two chains, we see fee problems, right? What do we see on proof of stake? Well, we have low fees, but now we have a network that's down for 7 hours and can't meet consensus. So that's kind of the quick and dirty comparison of the two. Let's go ahead and get into what everybody was waiting for, obviously. Ethereum devs decide not to delay Ethereum's difficulty bomb. So this is from, of course, Friday. And here's the summary. Well, this was written on Saturday, right? The 30th. But Ethereum's developers have decided not to delay the pending difficulty bomb, as the merge of its mainnet to the Beacon chain could still happen this summer. If all goes according to plan, Ethereum developers could be ready to fork testnets in 2 weeks, removing the need for the hard fork to delay the difficulty bomb. Here's what I don't understand too, because remember the previous call, is to give you the rundown, is that once you start forking testnets, they're not going to fork more than one every 2 weeks. So if in 2 weeks they start forking testnets, we still have 8 weeks to go. That puts us at essentially mid-July. Okay, so like around July 15th. By the time that happens, the block times will be increased because of the difficulty bomb to like 20 seconds, which is way over what they had said they were willing to deal with. Remember, they said they were willing to deal with 15 seconds. So everything coming out of their mouth in these calls, everything that's getting put into writing as well, is inconsistent with pretty much anything they've ever stated. Not surprising when we really talk about Ethereum's past in general, though. I just wanted to point that out. It's highly inconsistent. According to senior Ethereum developer Tim Biko, the team has 4 weeks to decide on the difficulty bomb. Ethereum's developers have decided not to delay the pending difficulty bomb, at least now. Additionally, there's still a possibility of a highly anticipated merge occurring this summer. This is according to the latest Ethereum core developers meeting highlighted by Christine Kim of Galaxy Digital. She says, here's the recap. Devs decide not to delay the difficulty bomb. Merge still hopeful for the summer. According to the Ethereum developers, if everything goes well with the shadow fork testing, they could be ready for the remaining testnets in the next 2 weeks. Consequently, they will not need to carry out a hard fork to delay the difficulty bomb. Furthermore, the effects of the difficulty bomb are yet to be fully felt, as explained by Tim Biko in the following statement. Quote, the Ethereum network is not being affected today by the bomb, and it's not going to be noticeably affected in 2 weeks. Realistically, we even have like 4 weeks to make that call. I think it's worth moving forward on testing, seeing how far we feel or we are in the process in 2 weeks from now and looking at it then. So from, of course, Friday, the 29th, we have 2 weeks. So not this Friday, but next Friday, we'll get more information, I think. Obviously, like we thought before, we were going to get more information this past Friday. That didn't happen. Welcome to reporting on Ethereum news. In an earlier analysis, Ethereum's difficulty bomb was expected to start being felt on the network sometime in June or July in the scenario that the merge would not be ready. So we also need to make this clear. The effect on the network in this definition is only to the end users, meaning block times. The effect of the network on the miners is not necessarily anything that they've approached. Now, we aren't really necessarily feeling it super hard on the miners, especially because we had an unprecedented NFT launch, but we are starting to see difficulty slightly go up in average. Now, and the hash rate's not following that, okay? So, over the next month, for May, we're going to start seeing essentially artificial increase in difficulty on Ethereum. By June, provided in 2 weeks they don't decide to go ahead and push the difficulty bomb back, by June we are going to essentially see some significant network effects from the mining perspective. We will start to slowly see a decrease in revenue. All miners will experience this, and we'll get into what that means here too as well in a second once we finish this. So in an earlier analysis, so we got past that part. The world won't end with 21 to 25 second blocks, says Vitalik. I told you guys, it's been inconsistent. What we initially were understanding is they didn't want to go over 15 seconds. Now they're perfectly fine with 21 to 25 seconds. Ethereum's Vitalik Buterin was also present during the core developer call. According to his analysis, the team has to evaluate the pain of doing an extra delay hard fork versus the pain of living with 21 or 25 second blocks for a while, which is something we have done before and the world didn't end. Of course, it happened before. We talked about this before. And sure, Ethereum continued. What's the major difference here? NFT marketplace, okay? We are talking about a huge difference in the amount of transactions that are going on in ETH, the amount of money that is sunk into NFTs, And it will be a huge difference just from the end user perspective, because there's so many more people going through so many more transactions at such a higher rate, at such a higher dollar point, at such a high price, that I think that sure, it won't end, but it could spell out, in my opinion, super doubt within the Ethereum ecosystem. Further expanding on Vitalik's comment, the Ethereum difficulty bomb increases the difficulty level of mining Ethereum. An increase in difficulty means that mining ETH becomes less profitable as block times increase. The difficulty bomb is part of the Ethereum network and is intended to encourage developers and miners to transition into a less energy intensive proof of stake algorithm. Let's be clear on what it really is. What it really is a poison pill. What it really is a trap to stop miners from forking Ethereum. Why would they want to stop miners from forking Ethereum? Because if miners were successful in forking Ethereum and something goes bad with proof of stake and they get shut down for 7 hours like Solana just did, and all the devs go, what the heck? This other chain that the miners forked is working perfectly fine. We're just going to go back to that. That's what really happens. Now, of course, we already have Ethereum Classic. We've seen this in practice and it didn't come to fruition over a previous split, but that previous split didn't go from proof of work to proof of stake. It just went from proof of work to proof of work with a more centralized attitude. So there are risks here, even just from, if you're pro proof of stake, you need to understand that there are risks here that are going on. And part of that is surrounding, of course, this battle between Ethereum developers wanting to move to proof of stake and proof of work miners wanting to continue on the network due to obviously revenue driven reasons, right? So this will get really interesting really quick, because here's another note that the article doesn't point out that you need to take into consideration. And that is that the amount of hash rate decrease directly will impact the block times. So what does that mean? That means the more hash rate that drops off of Ethereum, the longer the block times will get. So they can say that they predict that given the current hash rate, their block times could go up to, 15 seconds in June, right? But that doesn't actually play out to be true, because the factor here is how much revenue do miners begin to lose, and how much hash rate will drop off and start going to other networks as a result, thereby potentially exponentially increasing the block times on Ethereum very quickly. And so it'll be really interesting to see how this plays out, because inevitably what will begin to happen is that miners will basically do one of two things, right? Either Ethereum starts to drop below the profitability of some other proof of work algorithm and miners start to move to that algorithm, or, which is definitely more likely and definitely top of the list, is that Ethereum becomes unprofitable for the people that have higher electric costs. And as those electric costs basically start being more than the amount of revenue that the miners are making on Ethereum, they will start ditching their GPUs, and of course, the amount of hash rate on Ethereum will drop, thereby increasing block times quicker than they are estimating. So I think it's really important to take that into account. Now, Tim did say a few more things on this. Let's see. In a long post, I thought I had one pulled up that was... Okay, so let's try to parse through some of this. So he said we are at the end of the call by then, so we agree to reassessing in 2 weeks. And they were talking about proof of work. One, having 2 more mainnet shadow forks is what they want, and getting clients supporting and passing Hive test suites and fixing the outstanding bugs from the past shadow forks. The May 13th is the next call, so put that on your calculator. And it says one more important note on naming specific clients progress. Which one was proof of work? There was a lot here, so maybe I missed it. I thought there was one more about timing, and maybe you guys can help me out in chat, and then we'll go back to it in just a second. So realistically, what are we talking about from the mining perspective right now? I think we're talking about a very difficult month period, at least for mining profitability. And you need to be prepared to bob and weave through all of this pretty significantly. I think it's going to be pretty hard to be profitable. You need to get your electric costs down, which is going to be a big problem. I think right now we do have to start taking into consideration what other networks are going to be viable. I don't think, after talking to Daniel Keller on the interview, that they were expecting, obviously he said we're expecting to take over all the Ethereum hash rate. Sure, okay, cool, but there's a couple problems with that from a Flux perspective. One, AMD cards don't run good on it. Number two, he wasn't really expecting, when I quizzed him on so you'll be ready by June, that they would actually be ready by June. There's a lot more work that needs to be done there. There's other networks, but a lot of them are small. You have Ethereum Classic, but Ethereum Classic still has quite a few tools that need to be put into place before it's really ready. For example, just an NFT marketplace. Yes, there are NFTs on Ethereum Classic, but there's not a marketplace. There's not a centralized marketplace for people that are essentially in need of that. And if we're being honest, like things like, whether you hate it or love it, things like OpenSea are ubiquitous, meaning like just the normies are going into OpenSea. That's going to be the main marketplace. If you don't have something comparable to that, it's not going to play out right. So I think there's a lot of issues surrounding what moves end up happening next. A lot of other algorithms also cause problems. Ravencoin, for example, really hurts your core. So does Flux. Ergo is a great option, but it really just isn't large enough, and it has that weird difficulty delay problem that's going on. You know, we can find problems in all the networks. We will have to see what the miners choose and how much that influences price at the end of the day. I think overall, we can state beyond a shadow of a doubt that even if a ton of miners leave, just overall, sell their equipment and get out, there will be enough miners around at the end of the day to move to another network. And whatever network that gets the miner support, I will say, I think is going to be extremely bullish. So whether that's Ethereum Classic, whether that's Flux, whether that's Ravencoin, choose your coin, what you think is going to get moved to. And it's going to be a very bullish move because price discovery will follow that difficulty increase. Maybe not to an extent to keep all of the miners on the network, right? But enough to where, from an investment standpoint, not financial advice, because I don't know which coin that would be, but from an investment standpoint, could prove out to be extremely lucrative. Now, Ethereum, obviously, I wanted to talk about the burn that happened over the weekend. There was basically like over 200 million within those three hours for the launch that was burned for Ethereum. Pretty insane. That did not translate into an increase of price, though. And that will bring us to, of course, the markets and the market moves. Just a summary from CoinDesk. Bitcoin fell below critical price support over the weekend as several adverse developments worsened the sentiment. The top cryptocurrency suffered its second straight weekly close under the cloud support and psychological level of $40,000 US. The cloud acted as solid support several times since late February. Therefore, its latest violation may prove costly for the bulls. Veteran investor Warren Buffett, a longtime crypto skeptic, asserted his stance, saying he wouldn't buy all of the cryptocurrency even at $25. Quote, if you told me you own all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I'd have to sell it back to you one way or another. It isn't going to do anything. I think that obviously we are fully aware of what cryptocurrency, Bitcoin, and everything is doing, right? What was the quote? Let me pull this up for you guys, because this is a fun one that I got. And I want it to be clear, because what Warren Buffett is he's the dude that figured out, he's the dude essentially that figured out how to play Monopoly really, really well. And he figured this out, right, in a manner in which there are people that will allow you to continue to play, of course, the game of Monopoly or the game of life, and keep going on year by year, collecting your $200. You will never own any of the properties. Ta-da. Somebody else, the winner of the game, owns all the properties, but he doesn't want you to quit. He's enjoying winning the game. So he has you pass go, get the $200, and then when you land on one of his pieces of property, he takes your $200, even though that's all you have, and maybe the rent is actually $1,200. He's like, fine, you only have $200. Go ahead and go back around go again. And you go back around go, and then you land on one of his properties, and then you pay him again, and then you keep doing that over and over and over again until the system changes. And I think Bitcoin changes the system, and I think that he is aware of that. The legendary investor added that Bitcoin doesn't produce anything, suggesting that the cryptocurrency lacks intrinsic value. This brings us back to proof of work versus proof of stake. The intrinsic value, the thing that gives it value, is the energy cost utilized to process the transactions. Everything in this world is processed via some sort of energy. Energy cost is what ends up giving it its value. Now, what does it produce? Well, it produces an ecosystem for, obviously, financial markets at the very least, which is obviously going on right now. So I understand where he's coming from, as far as like, okay, we could get into farmland, we could get into like stuff like that. But if we talked about something similar like gold that you just buy and hold on to, sure, it's a resource, I suppose. But most of the time, that's not the way people are approaching it. I suppose you could also maybe put it towards stocks as opposed to this, but then you're dependent on a company. I understand the argument, I guess, is essentially what I'm saying. Other than the intrinsic value that I see where it comes from is obviously the power required to go in to produce it, if that makes sense. Let's go on though. Solana, the second largest market or smart contract platform by market valuation, suffered yet another outage over the weekend. Its 7th of 2022. Has it really been 7 outages in 5 months? I saw a tweet the other day. Someone said Solana's going to 10K on Sunday. I was like, nope. Come on, bro. 7 outages? As the flood of inbound transactions representing 100 gigabits of data per second knocked out validators. The 7-hour dark period was bad optics for Solana and Ethereum competitors. The smart contract token could nosedive again against Bitcoin during the crypto market's next leg lower, if any. Ethereum's transaction fees went through the roof due to the high demand for the highly anticipated virtual land sell. We've already talked about all of this. And they said, obviously, ApeCoin will need to migrate to its own chain, which is going to be a big deal. So I do want to go back to that. What does blockchain produce? It produces digital goods. Obviously, if we start getting into blockchain, as far as like Web3, NFTs, stuff like that. I don't know why. I need some sleep, boys. At press time, Ether trade at 0.8% lower on the day at $2,900. ApeCoin, or Ape, the governance and utility token for the Bored Ape Yacht Club, crashed 40% to $15, perhaps in a classic sell the news move. Well, that, and it was being utilized to purchase the actual properties, right? The Ape land sale has been the biggest attention-grabbing event in crypto lately. Members of the Ape community buying Ape token for the land sale, and other speculators drove Ape from $10-ish to $28. CK Shung, or Chang, something like that, investor at Defiance Capital, said in a Telegram chat, quote, on the day of the sale, both community members who bought Ape but failed to participate in the land sale and speculators need to unwind their position, leading to the unavoidable retrace after the major event. Steve Lee, an investor at Block Tower Capital, said, quote, those who bought extra Ape for this event might have to offload those amounts while they are in the Ape community, end quote. Lands were sold at a fixed price of 305 ApeCoin tokens per plot rather than an initially planned Dutch auction, which could have potentially driven prices significantly above that level. Elsewhere in the crypto market, fears of liquidations posing a systemic risk to decentralized finance and the broader market gripped investors after well-known phantom whale called Roosh faced liquidations worth $50 million US. Quote, the magnitude of the position for a relatively small chain led to fears that Phantom could collapse under the cascade of liquidations. Many on Twitter urged followers to get their funds off chain, end quote. Partner, let's see, Ian, is that Ian Solit? Partner at the Tagus Capital Multi-Strategy Fund said in an email. In a tweet thread, pseudonymous degen crypto farmer Tux said whale liquidations can lead to death spirals where all loans face forced closures. Quote, you're like, my borrow limit is safe and it's at 50% right now. What happens when a $50 million loan is liquidated, end quote, Tux noted. Quote, the price on chain drops 35%. Then someone who had 20% borrow limit remaining will get instantly liquidated. And then it ends up liquidating more peeps under him, her, and eventually you will be caught in the torrent as well, end quote. I want to bring something up. We've been talking about, this is the miner's perspective. We've been talking about large mining firms and their shift from going public and getting funds that way, basically having their own stock listed, their own security listed that investors purchase, and then they use that money to build their farms up. As opposed to that, they've been taking on debt. Now, the type of debt is going to be important here. I think if you are going to go get into debt for crypto at a large scale, you need to be extremely careful. It's something I've actually been looking into as well. But here's where things get interesting. We're talking about these basically within the crypto DeFi space, borrowing against the cryptocurrency that you have. A lot of the large mining companies have been basically using DeFi in a manner where they borrow against the Bitcoin that they have. If they get liquidated, we may see really good prices on ASIC equipment. That is potential here. So from the miner's perspective, if we are going to go back down into that bear market range of previous super cycles, we could see a lot of liquidations happen to where this does go back down to 21,000 or something like that. If a whole bunch of miners that have been borrowing via DeFi and putting up Bitcoin as collateral go under, you could see a bunch of ASICs hit the market for cheap, and luckily they're all in the United States now. And then on top of that, you also have the equipment-backed loans that are also going on. And if it gets too difficult for some of these large miners, if they are expanding too fast, if they don't have good power costs and so on, you could see equipment flood the market from there to pay off their loans. What does that moment bring you? All of this, as dark and doom gloom as it may seem, is all opportunity. So, I'm not saying pull the trigger right now or anything. It's not financial advice, but all of the opportunity is coming back into the market for people that do not already have large positions. So this is good news for a majority of us, especially home miners, etc. A lot of it does mean that as long as you're not over leveraged, haven't been taking out debt and that sort of thing, which we've talked about on the channel before, as long as we aren't doing those things, and you can get your cash flow kind of figured out, which is something I need to work on. I'm not good at that, not financial advice or anything like that. But if you can get that worked out, you can be in a position to suck up a ton of hash power, whether that be Bitcoin, GPU, or any other ASIC, and be prepared for the next super cycle to tick off when the next Bitcoin halving happens at the end of 2024, beginning of 2025. You'll probably be looking at another 6 months after that before it really takes off. Profitability will start to come back up around that time, and then it will do its usual thing. Let's talk about mining profitability as of right now, though. It's not great. Yesterday was much worse, but today, expected earnings on my farm, which is sitting at 5.25 gigahash right now as it warms up outside. With an average of 5 gigahash a second. Once it gets really warm, we'll start dropping to about 5 gigahash a second. Yes, I'm still working on ventilation. No, I don't have any news. It's a little stressful, but we're at 189 US dollars, which is equivalent to 0.067 ETH. If we go to the payout history, you can see yesterday was by far one of the worst we've had at 0.061 Ethereum. The day before that, the big one, we bumped up obviously from around that 0.068 to a 0.082 ETH thanks to that land sale. So that helped me clear some rent for yesterday on the property that we're renting for our mining facility. Next, we're going to take a look at mining profitability for the RTX 3090, keeping in mind, of course, that this should be adjusted now, but maybe not all the way. It is by far the lowest we've seen the RTX 3090 in profitability for Ethereum, which is at $3.34 a day. Let's go ahead and fix Zelhash here. That is after a 10-cent kilowatt average. Now, if we scroll down, it does look like Flux is in second place with the adjusted hash rate on the 3090 at $2.64 a day after power. And that is mining Flux directly, which is good news for miners because I would prefer to mine directly than going through NiceHash. Support the networks directly. After that, you have Equilibria, which is at $2.66 a power, a day after power. It's $2.60 a day of power would be rough. Cero at $2.34 a day after power. Conflux at $2.16 a day after power. Z Classic at $2.23 a day after power. Ycash at $2.22. Conceal at $2.26 and Rio at $2.15. One of the points that I wanted to bring up is that you are starting to see an increase in the profitability on privacy coins. Now, back in, of course, the first kind of bull run that I participated in, privacy coins were really kind of just starting to take off. That was the big thing. And it's interesting to see them start to come back around, especially given, of course, current world events, we'll put it that way. Even ones that had been pretty slow from a development standpoint, like Rio, have started seeing development back on the network. Things like Conceal, which are newer, are starting to pump up again. Cero is another privacy coin as well. So for GPU mining, you have 1, 2, and Z Classic coming back as well. 3 and 4 privacy coins within the top 10 for mineable coins. And that's going to be relevant. So keep an eye on the privacy coins for sure. Now, obviously the big daddy is Monero. But like we talked about before with the Z Classic and then of course Zcash in general, it does seem to have I suppose the strongest attempts to maintain the privacy out of a majority of them, right? So it's important to just take a look and pay attention to what's actually happening with these markets. We may see a resurgence of privacy coins here over the next few years. Let's take a look at, of course, the charts for mining pools and the hash rate. Of course, Bitcoin continues to rise in difficulty and hash rate regardless of the price of Bitcoin. It's at 232 exahash a second. If we take a look at Ethereum, it should be around 1 petahash a second. It actually has cracked right now 1.1 petahash a second. So there is an increase in difficulty that will be realized a little bit, not only from the artificial difficulty bomb, but the increase in hash rate. We could speculate on this a little bit. What I did notice was a lot of people kind of fell for that initial pump in price or revenue on Ethereum due to the Yuga Labs event. And even what we saw was yesterday, nice hash Ethereum rentals still way outperforming mining directly, which was intense, where you saw essentially, even though the block rewards had gone back to normal, people were renting out the Ethereum hash rate because they were being dummies and looking at what to mine. A lot of those guys lost out. It kind of sucks. That's why I tried to make the video as quick as possible. I think what we're seeing is obviously, I think here, a little bit of FOMO. And you can't FOMO in mining because the thing is, like we saw, that little 2-hour blip is just a little 2-hour blip. You have to play it by the numbers. You need to be pulling up things like Etherscan and checking and seeing, hey, is this continuing to happen? Is this a consistent thing that's happening, or is it not, right? If it's consistent and it's been happening for a couple days, 3 days, 4 days, and you're noticing that that is a consistent trend, then sure. If you see a big pump and then a dump, like a big like curve that's happening within these block rewards on Etherscan, then you know it was a one-off thing, probably an NFT mint. There won't be a huge Yuga Labs NFT mint every day. That's not going to happen. So you need to be very, very careful here. Let's look at Ethereum Classic at 27.34 terahash a second, down over the weekend. On Friday, we were at 27.7. So we have had a dip there. We've also had a dip in difficulty. Take a look at Flux hash rate at almost 2 mega solutions a second. Pretty consistent. And we're starting to see kind of a settling down of the network now that kind of the node craze has calmed down. This is good news for miners in my humble opinion, meaning you are going to be able to essentially get some steadier payouts and be able to calculate this out a little bit better. And seeing the hash rate right now, or the what to mine reports, this is looking strong as the second most profitable currently on the network now, or on blockchain. The only problem, or proof of work, the only problem here obviously is going to be the type of hardware that functions well on Flux, which is going to basically cut out all of your AMD cards. But you could take your NVIDIA cards and throw them on there, and take your AMD cards and throw them on Ergo. That's a valid plan. So let's look at Ergo too. Pop over there. And Ergo is at 16.94 terahash a second. On Friday, it was around the same, but there was a dip off and then a shot back up. This dip off looks like, to me, a FOMO in the ETH hash rate is what it looks like. And it was too late, unfortunately. But it is what it is. And then we have Ravencoin still sitting around 3.37 terahash a second and a pretty consistent difficulty right now. I think that's all we're really going to... I will look at Rio real quick. Be very careful with this one. Yeah. You can see here, last week we talked about it. There was a huge increase in profitability. What happened? Friday, we talked about it. This weekend, huge increase. Then once again, the FOMO back into Ethereum. You guys need to be more careful. I can see it in the charts what you're doing. I can see it in the charts. You FOMO'd into one coin with your hash rate and then FOMO'd right back into Ethereum because of a 2-hour blip. I can see it. I know what you did. Be more careful, guys. Come on. Slow down. Slow down. Slow down. I understand. It's getting a little rough out there. Believe me, I get it. But it's funny that we can see it in the charts right there. That is pretty fantastic. Let's look at mining profitability, mining pool profitability. Past 90 days, flex pool in first, mining pool up in second, F2 pool in third. Past 60 days, flex pool in first, mining pool up in second, F2 pool in third. Last 30 days, mining pool up in first, flex pool in second, crazy pool in third. For the last 2 days, crazy pool in first, mining pool up in second, flex pool in third. For the last 14 days, mining pool hub in first, flex pool in second, F2 pool in third. For the last 7 days, mining pool hub in first, flex pool in second, F2 pool in third. For the last 3 days, mining pool hub in first, flex pool in second, crux pool in third. And for the last day, mining pool hub in first, crazy pool in second, and flex pool in third. ASIC miner profitability, the Jazz Miner X4 is at $126 US a day on Ethereum. You have Inosilicon A11 at the 71, which is going to be another ET hash. The Gold Shell KD6 is down hard at $60.08. This is one thing I wanted to talk about because I've been talking about hedging personally into some ASICs. I'm not going to be grabbing ASICs that are not Bitcoin ASICs. Reasoning behind that is a lot of these ones like the KD6 that go for just a couple months ago, 60 grand? You know, there's no guarantee that it's going to maintain or even stay on the same algorithm. You have a lot of what ifs surrounding that. Bitcoin's in a unique position where the miners would have to vote for that consensus change and it would be against their own interest. And against the, changing the algorithm or whatever that may be. Sure, your profitability is not going to, or your revenue is not going to be as high. It's just a little bit less risky from the ASIC mining perspective here. Of course, there are the outliers that get really interesting. Hedging and buying small gold shell miners, you could have ended up with a 599 purchased gold shell Cadena miner that then now is making you a ton of money. So you could go and buy a few of those. Maybe you do think, right, not financial advice, but maybe you do think Handshake's going to go somewhere. So $600 for a Handshake miner, cool. Maybe you think Library is going to go somewhere, so you buy a Library miner. And then maybe the next bull cycle, you see like that resurgence, kind of like we saw with the L3 Plus, where like the L3 Plus, you were able to pick up for like $175. And then all of a sudden it was making a ton of money during this last cycle. So there are kind of those interesting options. I mean, even to the point to where if they're cheap enough, you buy a few and prep yourself. Once again, like I said, what's happening now is opportunity. So you need to see the opportunity. It may not be quite there yet. Maybe not the trigger pull quite yet, but there is going to be opportunity in all of these markets. That's another example of the opportunity, right? Let's say everything crashes out and all of a sudden you can pick up a Cadena miner for whatever, $175 before the next cycle. Well, maybe you just buy one Cadena miner and throw it in the garage and save it for that cycle, right? Maybe you find an L7 for super cheap. It's not as profitable, you know, when things take a crash, but you get one cheap and then it comes back, right? These are all things that could happen. Remember, like the L7 didn't even start really coming out again until people realized that it was profitable again. It's down as well, though, $36.20 a day. If we take a look at Bitcoin miner, S19 Pro that we take a look at every day, $12.53 a day. So all of them are looking pretty bad from the mining perspective right now. Nothing too fantastic, but not so bad that you can't be profitable depending on your power cost. So what's your number one goal right now? It's going to be the expand. It's going to be reducing costs. That's pretty much exactly where you're going to be at if you wish to continue within the markets, right? If you don't, then obviously you'll sell out and then you'll FOMO back in. Got to be careful here, right? If you time it perfect, you're going to be good. Maybe your plan is sell all your equipment off now and you buy it all right in the kind of Q4 of 2024. Sure, that could be viable. There's lots of different options. You got to be careful that you time it and you don't FOMO in when all the prices skyrocket again. That's pretty much it. Or if your equipment's paid off, which I hope it is, you just sit on the equipment for 4 years, right? And that's pretty much what you do. Mine at a loss if you can afford to. And that sort of thing. So we can see that the Ethereum difficulty is maintaining over 14.1p. We saw this release or this happening this week, essentially. We talked about it yesterday where, you know, for the past week until this really clicked in, we weren't really seeing it stay above 14 for a lot. Now it's kind of it's hitting these 14 peaks. Expect this difficulty chart to get much worse. Let's get into questions and answers. Once again, as always, super chats are always appreciated, never required, first to be answered because it highlights the message. It's not me influencing you to pay me. It's YouTube. But that would definitely help out in these times. Let's get into it though. Mark Gear says, hi Son of a Tech, can you explain how two miners works? That's a very broad question. Is there a specific piece of two miners that you're confused with? Are you experienced with mining to mining pools? Are you specifically talking about specific mining payout methods on Ethereum? Are you talking about, what are you talking about exactly? Rad CPU Man says, as Son of a Tech, you mentioned earlier in the show about providing flux liquidity over starting a node. Can you show where to do that? I've done a tutorial on it before, but you basically can do that within, Uniswap, for example, if you're going to do it on Ethereum, PancakeSwap, if you're going to do it on Binance Smart Chain. Cadena, I'm not sure. I could try to do, I'll try to get some Flux together and go over some tutorials. The problem is I'm working with a lot less funds to do a lot of that stuff. But I'll see if I can get one together. But you would essentially add you can watch my MetaMask tutorial, which we just did last week. And that shows you how to add basically to MetaMask the Flux token. And then from there, you would go to basically like Uniswap. You would use the same idea, adding the contract for Flux, and then you would provide liquidity through one of those applications. Same goes for Binance Smart Chain. GoldenEyeForever.com says, "Ask Son of a Tech, you messaged during Rabbit Stream that you think the merge is coming in June." So from my perspective, if I'm looking at it and we're not going to delay, it feels to me like it would be June right now. So it's not a typo. With the information I had at the time, that's what it feels like. Now, I saw a couple people message early on saying something about Tim saying it would be a year out. I don't think that's true. Now, when I listened to Bits Be Trippin', he said, Q1 of 2023 because of 2 specific bugs that he was worried about. However, when I looked through the dev call, those 2 bugs were resolved, and I think he didn't catch that. Daniel Ring says, "Ask Son of a Tech, another big tick in difficulty on script again today. My L3s are slowly fading into oblivion." Yeah, mine are probably getting to the point of needing to turn off at some point. Dan Sand says, "Ask Son of a Tech, how are your helium profits?" I just turned it off. 3 Mil says, "Ask Son of a Tech, my man." What's up, 3 Mil? Racco says, "The sooner the better. If ETH goes proof of stake, we can finally see if GPU mining stays relatively profitable. So I see it as a good thing. What are your thoughts on it?" Obviously everybody wants answers, but I would always point you back to the previous super cycle problem, where the fact is if you survive, the fact is this, if you survive the hard times, the good times are better, if that makes sense. But what we are going to see, what it feels like to a certain extent, is that we have a compounding issue of poor market performance for GPU miners, in addition to the move to proof of stake, making it very, very difficult for the remaining coins to stay relevant. Flux looks like it can stay relevant, provided it continues to provide essentially the infrastructure needed. And there's quite a few others. I think privacy coins, I think, are going to make a resurgence, like I said earlier. As far as wanting it to happen sooner, not necessarily, because I think if you could see basically a market dump first, it'd be a little bit better, potentially. If a bear market is what's happening. Isles says, "Ask Son of a Tech, what are the average acceptable temperatures for GPU mining on both Core and VRAM?" VRAM's pretty simple. It'll be dependent, though, on your specific memory type and GPU. Typically, 104 degrees and below on video memory means that you won't throttle any of the VRAM. In some cases, it can go up to 110 C. Core is kind of the same thing, where if you're wanting to not throttle, under 90 C is a safe bet. There's none that throttle at 90 or below 90 C. Obviously, lower is going to be better. Some would point out, obviously, degradation. Core degradation's more possible than video memory. So video memory degradation's not as big of a concern. The cores are a lot more sensitive. And if you have that problem, then you end up basically having to have more power to run the same card. So the lowest you can get on the core, the better, which is part of the reason why some of these other algorithm options like Kapow, like Zelhash, that sort of thing aren't enticing to me. I would rather the answer just be Ergo, for example, or Ethereum Classic, because they aren't as demanding on the core. Because I think the core degradation is the biggest threat to a big or a larger GPU facility. The gamer says, ask Tech, what kind of ventilation problems are you having? I was found the perfect solution in a small room is cooled by two 18-inch exhaust fans. So I used to run a 150 square foot room with 4 gigahash, and it was great. I had a hot side and a cold side, is perfectly fine. The only problem I'm having here, to be honest, is waiting on the contractors. The actual plan is in place. The actual ventilation method, all that stuff, we'll go over it once it's done. But the problem for ventilation has nothing to do with not knowing how to do it. It is purely has to do with, I guess, red tape at this point. Phone calls. The lady that was handling it had a baby, which didn't help. All that sort of stuff, right? Red tape. Colin says, ask Tech, have you read the article pertaining to the 2 U.S. senators proposing a new crypto bill to limit capital gains tax? I have not. I will look that up and maybe we can cover it tomorrow. Thanks for the heads up. Emmanuel says, ask Tech, I'm a home miner and my strat was to hold my mined earnings until the next bull run. But ETH seems that it could be replaced by some other chain due to the merge, or could NFTs keep it alive? Look, you'll always have a first mover advantage with Ethereum. Meaning that provided everything goes smooth with proof of stake, I think Ethereum will remain kind of top dog for the NFT space. There are a couple things they could throw it off real bad. One is this difficulty bomb and the public's lack of understanding of what's going on, and the devs' complete disregarding of the effect of the block times going to 25 seconds in this market. The other thing is the inability to withdraw Ethereum stakes post-merge, and the effect that will have on the market and the perception. The potential for proof of stake to break and have significant downtime like we see on Solana with over 7 different downtimes over the past year, which is only 5 months. That potential could, of course, because Solana is a perfect example of a centralized proof of stake coin that is fully possible with Ethereum. That could definitely hurt it. Lots of stuff, right? I don't hold any ETH personally. AJ Mustang says, ask Tech, do you still suggest we purchase 3070 founders if we can get them at MSRP? I don't know if I suggested 3070 founders necessarily. They are light hash rate GPUs. They're pretty dang good on Flux. So obviously, like, it's not going to be a bad purchase from the perspective of other options that are out there. I've been purchasing 1660 supers though. GoldenEyeForever.com says Tim's tweet is misleading about delaying the merge until 2023. He does this on purpose. He didn't say the merge delayed until next year. Right, so you need to think about this from, how do I put this kindly? Look, Ethereum needs the miners really bad right now. So they're in a position where they are directly over the group of people that they need right now. So they're going to play it like this. This is why I think that June is a reasonable explanation for the merge. Well, I think it would be July, right? July 15th or something like that. Because I think in 2 weeks they're going to announce starting to move all of the test nets over. It'll be 8 weeks from there. That'll be around June 15th. So if you basically have, okay, how do we, a hostile takeover would be a good position, right? So you have let's compare it to like a hostile takeover of a company. We could do like Twitter, and Elon Musk taking it over, right? So what happens in a hostile takeover is a company basically comes in and they offer such a good price, buyout price, for the stock of another company that company would violate their fiduciary commitments and therefore are forced to take the sale price, even though they don't want to. Now, everybody in the company is a little grumpy, right? They're these old workers. And the goal is to get these old workers to give you as much information and as much work as possible before they inevitably quit or you fire them. So in the plan, most of these hostile takeovers, the plan would be to fire a majority of them. So they're going to get rid of them. So what Ethereum's doing is a hostile takeover of the network from the miners, and the new company are the stakers, right? So their goal is to basically get as much information and work out of the miners as possible before ultimately firing all of them. That is exactly what's happening right now. So they just want all the miners, they want all of us to stay on the network as long as possible so that their block times don't increase to a point to where the network is crippled. And to do that, I think that they will say things like the merge is going to be delayed a few more months. They will say things in weird ways that hint at maybe it'll be not till 2023. They will come watch videos like mine and Bitsby Trippin'. They've probably been watching Bitsby Trippin' reactions, and that's why Tim has leaned towards that 2023 date. They will try to accentuate any opinions that come from us that make it sound like it may take longer, so that the people that we are talking to, which are the miners, the workers, are more comfortable with staying on the network so that they don't have a mass exodus that could potentially damage the network before they're ready. Just like if you had a hostile takeover of a company, you need those workers to be around long enough to where you build relationships with their clients before they leave. Ricardo says, as Ravencoin, I have made more money in bears than bull markets. I believe is when the real fun begins. So I'm not concerned about the merge. Actually, I'm impatient to go on. Call me crazy. No, I mean, that makes sense. I am looking forward to being able to hopefully buy some ASIC miners without paying an arm and a leg for them. Scott Schultz says, as Ravencoin, I keep hearing people say they're getting better numbers on Twitter suddenly. I think it's just bots, to be honest, but have you seen increased engagement? No, I have not personally. We've picked up the average, I think. We could look, I guess. What is it? Social Blade. It'd be kind of fun to look. I don't want to look at my YouTube numbers because they're terrible and it's depressing. No, not at all. Not mine at all. We're still sitting basically around the same that we always do. I can show it to you guys. Boom, there we go. So I'm actually down 43% on the tweets, which is silly. And we're down 58% on the followers. So now, I mean, like, we're down. Now, for the last 30 days, technically we're up at 11%, but you can see here, we're losing followers because we talk politics and some of y'all are little can't handle other people's opinions. I get it. It's fine. That's the way it's going to go. Now, I think that It looks the same, dude. It doesn't look any different. Snarks Domain says, "That's not a tech. I was running into MJT issues on my card that only had putty. I guess I was lucky in the winter with the cold winter air blowing behind my rigs." Of course, man. We have a super chat from Wes for the $2. Thank you for the $2. Super chat says, "Just mine ETH and convert to Bitcoin with 2 miners. It's a possibility, but 2 miners, obviously their profitability, like we saw today, has been really, really bad compared to other pools." Snarks Domain says, "Now I've done 2 3090s with 1.6 millimeter copper and the putty on either side of the copper shims. 125 mega hash a second at 84 degrees Celsius. Memory temps 90% fans." Nice. Dave says, "That's time of tech. What is a good resource to watch to see when NFT drops and such are scheduled?" I mean, follow the big accounts, obviously, Bored Ape Yacht Club, Mutant Apes, those types of things. You can go to OpenSea and see what the big ones are, and then go follow whoever the artists are and pay attention to them. Detroit Iris says, "That's time of tech. Founders are FHR, not LHR. Minus the 3080 Ti." Okay, makes sense. Infinity says, "At Son of a Tech, what equipment would you suggest for a beginner miner starting today? Something under 6K. 1660 supers." Krylo says, "At Son of a Tech, sent super chat earlier. Guess it sunk into chat earlier." Yeah, I don't have one up here. It was probably before we started Q&A. Sorry I missed it. What was your question? John Lemon says, "At Son of a Tech, Crow pulled card rewards." I did notice that. I was going to look at that today, but I haven't got it into it. GoldenEye says, "At Son of a Tech, so Tim is basically a troll." No, Tim is a businessman trying to manage a hostile takeover. Scott Schultz says, "At Son of a Tech, in the end, the ETH devs are only able to manipulate the miners because of our greed. Profits over principles, sad but true." I think that's a fair point. It's All Good Mining says, "At Son of a Tech, you seem to be the only YouTuber saying June. I'm with you, bud. People are being strung along." Jorge says, "At Son of a Tech, just do more clickbait." Well, I got to do more clickbait to make up for that YouTube revenue. Chadwick says, "At Son of a Tech, 100% on ETH's hostile takeover." Lord Beerus says, "At Son of a Tech, I moved to Crazy Pool 3 days ago and got nothing during the insane ETH gas fees." I noticed that. If Crazy Pool would have even hit one of the big blocks, it would have paid out more than everybody else, and it hit none of them. It was... I'm laughing because I noticed it, and I was like, oh my God, that's terrible. Oh, what happened? How did Crazy Pool miss the entire 3 hours? It's just like the whole pool turned off for 3 hours. It was bad, dude. It sucks. Minor Illusion says, "At Son of a Tech, have you used any of those 45-degree brackets for your GPU rigs?" No, I don't think so. Kurosaki's Corner says, "At Son of a Tech, N minus 3070 Ti." I don't like the 3070 Ti. I know other people do. I don't. Dave Jack says, "At Son of a Tech, do you think the bear market I will need to shut off at 4 cents Canadian per kilowatt hour?" No, I think you're perfectly fine. We could do calculations, right? I have to do a little bit more. But I mean, even if we go... I mean, what's the point that we cut off on flux? Is it... Here, let's just do it. Like right now, let's just like look. Is it 20 cents? No. I mean, is it like 40 cents? What about on Ethereum Classic? It would probably be better to look at Ethereum Classic, I would think. Yeah, so what would it be on Ethereum Classic? When do we go negative? 30 cents? $27. Somewhere around, I mean, probably somewhere around 25 cents a kilowatt hour. But obviously that doesn't, it's not indicative. Like, we can kind of like guess, but we can't be positive, right? That's kind of part of the problem. All right, boys, that's going to wrap it up for today. Thanks for 450 concurrent viewers. I was hoping to hit 500 again, but 450 is pretty good. Let's see if we can do over 400 concurrent viewers tomorrow, which is a Tuesday, which is my favorite day, but unfortunately has always been the worst day for our stream. So hopefully we get that fixed tomorrow. Be sure to hit the like, comment, subscribe, and the notification bell, and share the stream out with your friends, family, and mining peers. I hope that you got as much information as possible today out of the episode. I feel like we covered a lot. And yeah, I'll take the position that July 15th is going to be the merge. Not financial advice. And I could be completely wrong. And Ethereum's delayed so many other times before, and they could not be ready. The other thing that could happen is that the merge happens and the whole network takes a crap and they roll back to proof of work. Who knows? All we can do is move forward. I'll see you next Tuesday.